Hello everyone, George DeSantis here with a look at the market for the week ending Friday, March 20th, 2020. I did do a video on Thursday, which was a special one dealing with a few different things with individual stocks. And this is a regular weekend look at the market. I will use the usual format, but I'll add a few other things from my viewing of the two videos that I sent you links to, one by Larry Williams and the other by Jake Bernstein. So we'll talk about those as we go along. As is usually the case, just take a look at this disclaimer. We all have to use a disclaimer, for legal purposes. So realize that I'm not attempting to give any particular person investment advice here. We are discussing the market in general and even some individual stocks, but it's not addressed to any particular person. Couldn't possibly do that. So let's start with a weekly chart of the S&P 500 as we usually do. Um, it's a little crowded, but we'll get through it. Let me crunch it up a little bit so you could see. Okay, so what we notice first of all with the moving averages is that the 4 EMA, exponential moving average, that yellow line, crossed below the 9, which is this red line here, crossed below it here. So on this bar, which is February 28th, on the weekly chart. But it did cross, like when we see on the daily chart, we'll see that it really crossed early in the week. We can also note that the 9 EMA, which is the red line, crossed below the 30 weighted moving average a week later on this bar here. So those were the first early signals that this market was beginning to roll over. And at the same time, we could see that the parabolic, using these particular parameters that I use now, parabolic turned negative right on this bar too. And parabolic is remaining above the most recent bars, indicating we are still in a very strong downtrend. MACD turned negative here, bearish, and it's remaining there. Williams percentile did the same thing, crossed below the magenta line, and you'll notice that it was above the magenta line for a long time before that. Also, you can see the sum of the rate of change indicator crossed again, and I put on the stochastic with these parameters here, 1233, because I saw something by Katie Stockton. She's a long-time technical analyst who is really good at what she does, and she's been around for many years. I remember seeing her years ago on television, and she was saying that we are finding support most likely at 2305, and that we should look for a bottom when the stochastic turns positive. Now, stochastic can remain at this level here, the 20 level. This is 80%, 20%. It can remain at that level in a trending market, which is what we have here, downtrending market. So it's an oscillator, and oscillators do best in a non-trending market. So we can begin to pay attention to the stochastic, as Katie Stockton suggests, because if it crosses above on the upside, it may help us to determine the bottoming of the market. You can see what happened here. You can see it turned up here. It took a little while, but it turned up here at the end of last year, at the end of 18, and then again here. When was that? That was June of last year, and so on. So you could see that the stochastic may give us some indication of a bottom. That's basically the point. So here's a daily chart of the S&P 500, the one we always look at. And you can see that at this point here on the chart, the parabolic went above the most recent bar. That was 220. And on 221, it remained above the most recent bar. And then again, as we continue to 224. On the weekly chart, we saw that this week here is when the market showed us, these 5 days here, the market showed us that 4 crossing below the 9. But if you're using the daily chart and your sell signal is to sell when the 4 crosses below the 9 on the daily chart. This took you out early. You didn't have to stay for this ride all the way down, which was, I guess, very nauseating for a lot of people, you know. So that's why I use this as one of my sell signals. And the other is the 6% from my buy price. So if I buy a stock at 100 and it goes to 94, I'm down 6%. I sell. No questions asked. I made a bad decision. It's too early to buy. Maybe I'll buy it later. But if I buy a stock for 100 and it goes to 125 and then it starts pulling back and the 4 crosses below the 9, I say, hey, you know what? I got a nice gift. I'm taking it. Okay? Market was kind to me. Let me take it and book the profit again. I'll come back another day. People who make money in the market find ways to survive and to avoid losing money. And this is my way of trying to avoid losing money. That's why I got out of Microsoft and Apple right here. Those were my 2 biggest holdings. I had 2,000 shares of each of them. Now, apart from this 4 crossing below the 9, you could see that the 9 crossed below the 30, right about here on this day here, let's say, right, the next day. And they continued to maintain those positions throughout this downtrend. So you don't want to be buying here because you're in a downtrend. The 4 is below the 9, 9 is below 30. You're in a downtrend. Let's look at the parabolic remained above here just for a brief while. It went below, but look at this. It's now above the most recent bars again. Now, if you look at MACD turned negative or bearish right around here at the same time. And Williams percentile, as an indicator, as you know, which I love, Larry Williams developed this. Look at what Williams percentile did. It crossed below. It says get the hell out, and it stayed below. Now, those of you who can do more programming than I can, maybe you're interested in backtesting on a daily chart whether you could trade just the Williams percentile. If it crosses above the minus 50 line, you buy. When it crosses below, you sell and maybe even go short. Hey, if you want to do that, be my guest. Might not be a bad idea. Look at some of the rate of change indicator. It crossed below this 4% line in a very pronounced way as well. So we do have this continuation of a downtrend, no doubt. I didn't need to go through all of that, I'm sure. Because we only have 15 minutes to do these videos on YouTube, I'm going to do 2 today. I'm going to continue on the theme of the general market, and then I'll do another one with some individual stocks. So continuing with the general market, here's Apple. Well, Apple is an individual stock anyway, but here's what happened to Apple. It topped out here. You can see this double top here. There's a double top. I started getting worried there because I had a lot of money invested in it. And then when it started doing this, and not on this chart, you can see the 2 cross below the 4 somewhere here and start to get out. Okay. Now this is Apple. You can see a very bearish engulfing candle, and on very high volume. No need to get excited about Apple yet. Here's the new high, new low index that my friend Alex is so fond of, and the way he keeps an eye on it is if it drops all the way down here like this, as it did back in 18, I believe, at the end of 18, and it goes back, you don't buy until it goes all the way back up, crossing this minus 4,000 line, and then it rallies from there. You will probably miss some of this move, but it's safer to get back in when it crosses here. You get some confirmation of a turnaround, you know. So if you're looking for turnaround, things that will indicate to you there's a turnaround, this is what we're looking for on this chart. I'm still thinking about when do we turn around? When do we start getting bullish? A long way from there. But you can see we have 2 blue bars in a row now on the impulse system. So we're allowed to go long or short. I'm not buying anything much these days, but I'm keeping my powder dry and looking at that long watch list that I made up. Here's a McClellan oscillator. And you can see that it seemed to, on the daily chart, seemed to have been putting in a little bit of a double bottom here. So that's encouraging, because if this thing starts trending up more and goes above the 50-day moving average, it might show that we're getting some support here. And here's our chart of the percentage of stocks that are above of the S&P 100 that's above the 200-day moving average, and you can see it's still way below 50%. And 50% is an area where we can start trading it. So we're way out of it for now. MACD is trending up though, so some encouraging signs, but not enough to make me put my money on the spot. And this is a daily chart of the S&P again, showing you those indicators that Jake Bernstein uses. You will see it on the video if you look at it. And here are the parameters. You know, he has a 10-day moving average of the highs, and a simple moving average, and a simple moving average of 8-day simple moving average of the lows. So the way he uses it, as I understand it, is that the setup is for a buy signal is when you get two consecutive entire candles or price bars above this 10-day moving average of the high. Then you look for a trigger here, and if the Williams percent R is above, you can buy. But if it's not, you know, if it's below here, the average, the 15-day moving average, you cannot buy. So this is how he uses it. When you look at the video, you'll see. Now you notice what happened here on the daily chart is you got two complete bars below the 8-day average of the lows, right? And you can see that there was a trigger here to sell. So this is where his system issued a sell signal. And you can see that the momentum signal was right here too, and also the detrended price oscillator, which he uses sometimes. So that's Jake Bernstein's chart. So what he'd be looking for, I think, is you'd be looking for a turnaround where the setup is to buy this market. Setup would be 2 bars completely above the 10-day simple moving average of the highs, right? So if you get 2 complete bars and the Williams advanced decline line is above the 57-day average, then you will have your buy signal. So we can keep an eye on that. And of course, these indicators should also be trading above this key level here. We'll take a look at that as we go along. So let's try to answer the question, George, when do you think we should be buying this market again, whether it's individual stocks or the indices, etc.? Here's the first thing. Here's a VIX, the volatility index, and you can see on a daily chart that it seemed to have topped out here and is starting to roll over a bit. However, we can't be too sure about that yet because we do have a hammer here, and this may be an indication that we're getting ready to go back up. Okay, in any case, this is at a juncture here where VIX may continue to go down, and as VIX comes down, it's inversely related to the rest of the market. Market should go up. So it's just a correlation. Now you notice that MACD is still above the zero line, so it's saying that VIX might continue to go up still. And then Williams percent R is above that line, that magenta line. Likewise, this indicator. So VIX is not telling us that we should get in the market yet. The next thing we should look for is the 4 crossing over the 9 and the 9 above the 30. 930, that is a stronger indication. 9 crossing above 30. Okay, so that's the next one. The next thing we're looking for is we'll take a look at Jake Bernstein's indicators. And what we're looking for is 2 complete candles above the 10-day simple moving average on the daily chart, and a signal from the Williams advanced decline line, accumulation distribution line. Okay. Oops. And lastly, we'll take a look at the Ishimoku cloud. We need to get back above the cloud before we can consider this market having some juice on the upside. Have a nice day. We'll talk to you again next weekend about this.